Ok.
Hello, everyone. My name is Alfonso Deus. If you don't mind, we are going to wait a couple of minutes just in case somebody else will join the webinar. So I think that we can start. Hello, everyone, and good afternoon. I am Alfonso Deus. I am responsible for the public sector practice in BBVA, and I am a member of the Sustainability Committee of CFA Spain since 2023. I'm pleased to welcome you all to this webinar. Today, we are going to discuss a critical challenge at the center of the energy transition, the strategic minerals dilemma. How investors can balance the soaring demand for critical materials with the environmental risk of extracting them. It is my great pleasure to introduce Daniel Will, Chief Sustainability Officer at Bank J. Safra Sarasin. Daniel has over 20 years of relevant experience in sustainable investments, including past roles such as Global Head of ESG Strategy at Credit Suisse and co-CEO of Robeco. Also, Daniel holds a PhD in environmental engineering from the ETH Zurich University. Today, we will explore how the extraordinary demand for critical materials needed for the energy transition is colliding with severe environmental and social risk, and more importantly, how investors can successfully navigate these challenges. Please, Daniel, the floor is yours.
Thanks a lot, Alfonso, for the kind introduction, and a very warm welcome also from my side. Thanks for joining this evening. I know it's late, but I appreciate very much that you join us for this very important topic indeed. I hope we can show a little bit why we believe that we might be at the beginning of a new commodity super cycle, particularly with regard to critical or strategic minerals. I hope we can also show why the fact that these materials are needed for the energy transition make it a dilemma for sustainable investors and make it necessary to not just close our eyes in light of the challenges adherent to these topics. And finally, I hope we can show a little bit what we believe is a pragmatic and forward-looking way how we can deal with these challenges. Now, before we dive directly into the topic, I would maybe want to say a few words on J. Safra Sarasin and our approach to sustainability, for the simple reason that I believe once we understand the concept, the philosophy, and the tools that are available to deal with sustainability challenges, it's a bit easier to have the discussion also around the strategic materials. Fecha Group is located in Switzerland, but internationally active. We focus mainly on wealth and asset management, with currently about 224 billion Swiss francs under management. For us, it is important to be 100% family owned. Why is that? Well, as you can imagine, if it's family owned, that also means we have a very long-term perspective, which is a very good match with the idea of sustainability. So we may think in decades and generations. That also means our ambition is to be very stable, very reliable. You can see that, for instance, with our Tier 1 capital ratio of about 43%. Now, within asset management, we take care of about 50 billion Swiss francs. Besides the private banking aspects, we do distribute outside the bank to institutional or wholesale clients. Private banking and asset management otherwise is about 50%, as you can see here in the middle. We provide solutions across asset classes, and sustainability is at the very heart of what we are doing and offering. You can see that from the ESG credentials on that slide as well. Now, it's a big word, I say commitment to sustainability, but I do believe if we have this lens and we do have this philosophy, it has to have an impact on the group and the company overall. I base this statement on 3 pillars. On the one hand, it's our own corporate sustainability, how we operate the business, and maybe more importantly, what we do through the investments for our clients. In my view, in the financial sector, investments are the biggest lever we have to also move capital in a more sustainable direction. Finally, we collaborate very often with external organizations and partners to contribute to the topic also in the evolution within the society. We apply a strict governance around the topic. Our highest governance level for sustainability is the Corporate Sustainability Board, closely linked to the Executive Committee of the bank. We have an ESG committee for more operational questions. And finally, an external sustainability advisory board who helps us taking the right decisions when it comes to strategy developments and new topics. Now, why sustainability? Why are we looking at the world and the investment space through a sustainability lens? It's not so much just a flavor of the day. It's also not so much regulation, because actually we started much earlier with these topics. And why is that? It's at the very true heart of understanding the industry and society and the drivers which motivate the companies to be successful also in the future. And we all know currently there are some headwinds in the market for sustainability. That's certainly true. But it was a big relief for me to see that in the annual poll of the World Economic Forum, which was published again just a few weeks ago in January, the global leaders have been asked in the economy, in politics, in science, what do you believe are the most important topics and risks for humanity and the economies we should take care of? And we saw that, of course, with a 2-year perspective, geoeconomic confrontation, state-based armed conflict are at the forefront for good reasons. We are all worried about that for sure. That's what we read in the newspapers every day. But with a longer perspective, the 10-year perspective, it's excellent to see that the leaders have not changed their position. They do understand and support continuously that actually 7 out of the 10 most important risks they identified are sustainability related, majority of them environmental, but not only environmental, also social. So if we want to provide attractive investment solutions which address these risks and also opportunities, and if we want to identify companies for investment which are in the best position to deal with these upcoming risks and opportunities, sustainability is just the logical choice. Now, we say sustainability, but actually the topic, and I have been working with it for over 20 years, has developed a lot. In the very beginning, when also Bank J. Safra started, it was mostly about exclusions, staying away from topics that were not at the flavor, where people said, I have ethical concerns, I have my values, could be tobacco, child labor, environmental pollution. That was not covered anymore in sustainable investment approaches. But very soon after, it was realized in the market that sustainability is a lot more, that these can be truly material factors which influence the future of a firm and therefore also an investment outcome. That was the time of the UN PRI, which I'm sure you're familiar with, and the time when asset managers like us started to integrate insights, risks, and opportunities in investment approaches. And I would say only over the last decades, particularly triggered by the Paris Climate Agreement and the release of the United Nations Sustainable Development Goals, a third element arise, and that's the contribution to more than just financial outcomes, contribution to the Sustainable Development Goals, for instance. I would say our bank has always kept up with these developments, but I also understand that in the current market environment, sometimes these three elements of sustainable investments are a bit mixed up. When do we exclude? When do we integrate? And when do we contribute? That brings me to this, what we call the wheel of sustainable investments, which we now can apply in many topics, also on the question of strategic minerals. We have these instruments available and we can mix and match them in the best possible way for an intended outcome. We can, of course, exclude when we have big ethical concerns. We do know that we don't change the world by doing that, but at least for our own consciousness, for our own values, we can say we don't have an exposure. We can and should, even from perspective of fiduciary duty, integrate ESG risks in investment approaches. And we can, but we don't always have to, also target non-financial outcomes of investment strategies. Some of our clients do intentionally want to have non-financial outcomes as well, whereas for others, this element is less important. What I believe is always possible is the application of stewardship. We can do engagement, we can do voting with a focus on ethical concerns in firms. We can engage with regard to financially material sustainability factors, or we can engage for impact orientation. So in combination, that gives us a good tool set to deal with various sustainability challenges. After this brief introduction, I would like now to come to the strategic minerals dilemma itself. Well, what are strategic minerals? There's not a very clear definition, but they are usually understood as materials, particularly metals, that are used to trigger change. They enable progress, they enable the establishment of green technologies, and they are particularly important for the energy transition. You can see a few elements here, like copper, for instance, which we need for power grids. Many of these materials are used for electrification or batteries like lithium, cobalt, nickel, and so on. But what also comes with them is that they are very delicate in terms of supply chain disruptions. They are not really available in a great abundance globally, and in many cases only in specific locations. We all learned that the hard way when it became clear that most of the rare earth minerals come actually from China, which gives China quite some control, and also an instrument they can use in trade conflicts. Internationally, the governments have indeed realized in the last few years how important these materials are. Probably also has to do with the deglobalizations, showing that if we rely too much on one single supply chain, we expose ourselves to significant risks. That's why the US and also Europe have both identified the critical materials they think are key for their economic and political development. You see a list here. They are, I would say, mostly consistent with a few deviations. Copper, for instance, was found in the EU to be not so critical, but very critical for the US, maybe connected to their power grid rehabilitations. Whereas then zinc, for instance, was found to be more important in Europe than in the US. But overall, it shows that this list is the critical list. There's a few more, but these are maybe the top 7 or so. It also shows that many of those are very much concentrated on a few producing countries. Look at, for instance, the platinum group metals, the PGMs here, more than 75% coming from South Africa, or another quite known example is cobalt, which originates to over 60% from the Democratic Republic of Congo. Now that was 24. In 25, the situation already got a little bit more heated and some of the governments started to take first actions. So for instance, the US started to apply a tariff on steel and aluminum, not just to punish their trade partners, but also to make sure that the production in their own country has a chance to grow and to supply directly to the country. China used its weapon of the control of rare earth elements to hit back at the US when the US imposed some tariffs, and only towards the end of the year, they at least agreed on a 1-year truce. Means it's not over, but for now, China agreed to not fully restrict the supply of rare earth elements, but it depends, of course, on the US and how they deal with the trade tariffs. President Trump has also expressed clear interest in some of the countries which may jump in to replace some of the existing rare materials providers. That's certainly one of his interests, why he wants to go to Greenland, and also why he wants to support the Ukraine in the hope to secure some of the resources there. Interesting also to see that at least the US government has taken direct action to get involved with companies to secure the supply. One agreement was with MP Materials on rare earth supply from the US, and the Department of Energy had taken a strategic stake in an American-based lithium project as well. So I think this is enough proof that you don't even have to necessarily believe in sustainability and green to realize that these elements are critical and there could be a shortage going forward. This is also supported by the observation what's going on in the alternative energy space, so the renewable energy space. Against all messages around the end of ESG and headwinds, and now everything is turned around, last year was a record year for the establishment of new renewable energies. Even in the US, 90% of energy sector investments went into alternative energies such as wind and solar. Solar alone was over 80%. In parallel, China invested in 2024 already 277 gigawatts in solar power, which is 60% of all the installations globally. So these are huge numbers, and it's a bit hidden now. It happens in the background. It even happens in red states such as Texas, but it is happening. And if you see here in the chart that currently non-fossil fuel energy supply is only 18%, the potential for further development is huge. So there will be more pressure on the materials that are used. And we can see that already with the example here of a couple of these materials or metals, copper, lithium, and nickel. The dark blue bar is the global use of these materials for clean energy, and the light blue bar would then be other uses, and we see the importance of this dark blue bar growing tremendously. So clean energy already is now the majority of the global lithium use, whereas the others are catching up. Why is that? Well, let me give you a simple example. If you compare a car with an internal combustion engine with an electric car, the whole construction is very, very different. Of course, in a conventional car, you also need some copper for the cabling, some materials, some metals. But the electric car, with the batteries, with the electrical engine, needs a multiple of this material. Copper alone, an electric car needs 140% extra on top what a conventional car was using. And the same is true for other metals like lithium, nickel, manganese, cobalt, and so on. So if we use that as a projection, and you can say it's maybe a bit too optimistic, but at least if you trust the projection of the International Energy Agency, which expects that the EVs, so electric vehicles, will grow 25 times by 2040. This has a tremendous impact. Currently, 20% of new cars are electric, and this number is going to grow. If we do these projections, it means that by 2040, we need the full supply for copper alone of a country like Peru. And Peru is the second largest copper provider, producer in the world right now. That shows a little bit the dimension, the extent of what is needed. Another example, more in the domestic space, let's assume we want to provide electrical energy to 75,000 homes. You can do that with a 100 megawatt gas turbines here on the left-hand side. If you want to replace the fossil fuels with a wind turbine, you could use 5 megawatt. That's a typical wind turbine. You would need like 20 of those. And below you see what that means for the use of materials and metals. So specialty metals use increases by a factor of 15 from 100 tons to 1500 tons. So from various directions, huge pressure on this sector. Now, what does that mean in terms of mining? Unfortunately, the mining sector is very slow and not very fast in reacting to increased demands. Well, why is that? The mining side is something complicated. Typical lead times from the discovery to the actual production of the material is over 16 years on average. So why have we not done more? Well, in the last decade, commodity prices were relatively low, metal prices were relatively low. There was not a lot of motivation for the upstream miners to invest a lot in new sites. But that also means now that even if they wake up now, and they do wake up, they are investing more, it's not so fast. So we know already what new mining sites will come online in the next couple of years. And you can see that on the right-hand side. Even if all the now known projects, which are not even yet implemented, are going online, we will still face a gap. So we are calculating a 31% shortfall in the project pipeline by 2035, which indicates another shortage we have to somehow live with. Now, this is a sustainability seminar this evening, but the green transition is, of course, not the only driver behind the need for strategic materials. Other drivers are also playing a role. For instance, infrastructure renewal, particularly in the US. It has aged quite a bit. They have to catch up. This is why they have huge infrastructure programs that will put additional pressure on the metal sector. Urbanization in general, people are moving more and more to an urban environment from the countryside. That comes with more luxury. It comes with more applications. In the countryside, you needed less of those. And again, additional demand for strategic minerals. Emerging countries grow, combined with even more urbanization. So altogether, pressures on top of the green transition, which we want to support. So I hope that's a little bit the background of why we believe there will be so much demand for these strategic minerals. And that's now a dilemma for us as sustainable investors, because it's an extremely unsustainable sector. Many of our clients so far have said, we don't really want to be exposed to these sectors for obvious reasons. Nobody will blame them. Unearthing strategic minerals means moving a lot of earth and soil. You either have to dig from the top, or for some metals you can do a tunnel. But I give you one example. If you get out copper from the ground, you have to take out 400 times the material you actually want to find the copper. So huge movement of earth that leads to a lot of emissions from the construction side. It needs then a lot of chemicals that are used in the extraction. Explosives are used, dust is being produced, and very dangerous, a lot of tailing ponds, which is basically a mixture of sludge, heavy metals, water, and chemicals is produced. We had several accidents already in the past where people died or huge parts of the environment was destroyed. And once the mining site is closed, you find what you see here in the pictures, and you may want to think about what does that mean for biodiversity and the further use of these landscapes. But there's also social challenges. In a geopolitical context, it's very unfortunate that many of these main producers of strategic minerals are located in areas where probably the adherence to the rule of law is not so great. Take again the Democratic Republic of Congo, producing 70% or so of the cobalt, is one of the countries which the weakest governance, which also means there's a lot of corruption. but there's also many questions around safety, work conditions, adherence to human rights, even child labor. How are they dealing with indigenous people and their land use rights? We find a lot of violations around these locations. Now, if we only look at the large mining firms that are operating there, they may have once in a while also an incident on the health side. They may have an involvement in some bribery cases because they operate in countries where this is maybe part of the rule. But I would say mostly they have their operations under control. I just checked the numbers. Globally, within big miners, well, still a lot, but it's about 100 casualties still that are created. But what's much worse is that the operations of large miners also attract the so-called artisanal and small-scale mining operations. And they, believe it or not, they suffer from over 100,000 casualties every year. So who are they? Well, these are informal workers that go close to official mining sites, typically poor families, maybe small villages, which participate in the extraction of these materials. They dig their own tunnels with simple shovels without many protections. These tunnels sometimes then collapse. They are locked in, they die there. They are usually not so easy to be rescued. They send out in their own children, which then, of course, don't go to school during these time periods. What makes it worse is we just learned before that the big mining operations, they are very slow in reacting. So even if commodity prices go up, it takes a while until they explore their new sites. This is a bit different for artisanal and small-scale miners. They compare the prices very easily. So if they believe, and these are very poor people, they can make more money in mining instead of in agriculture, they will leave their fields, go to the mines, and start digging their tunnels there at the risks we just described. And that's a problem. So if you look here at the share of artisanal small-scale mining in the overall mining, it's already a lot, you could say. It's 20%. For things like sapphires is 80%. But the share even goes up substantially if commodity prices are higher and millions people go to these mines. So in the past, maybe the large miners have ignored that problem, but slowly they're opening their eyes as well to what's happening around them. So in combination, this means there's quite a few challenges for the mining sector to address. There is often corruption involved. There is questions about labor management and human rights in labor, health and safety issues with the staff, with the miners themselves. They are often, the miners, not very transparent for the reason that they know there are problems. On the environmental side, we have negative biodiversity impact, toxic emissions, and a lot of carbon emissions as well. So what can we do about that? Well, the miners themselves, but also as investors, of course, have several levers that can be used to improve the situation. We can improve operational efficiency with better equipment, rehabilitate the sites after use. We can engage with the companies to have better labor practice. We can deliver safety equipment. We can use renewable energy instead of fossil fuels, and so on. They have become, to be fair, a bit more transparent in terms of what they report and their challenges. You see the development of the 25 major mining companies when it comes to transparency. So out of 10 indicators, which could be reported by firm, in an optimal case, 10 times 25 would be 250. We are not there yet, but almost 200 indicators are reported by now. That at least gives us transparency as a starting point. So what can we do as investors, indeed, to create a solution for sustainable investors? And we believe it's a couple of elements which have to come together. On the one hand, we should look at the whole value chain and not just the miners themselves. We want to know how the mining value chain works. What are solution providers that improve the situation in the mining industry along the value chain, and how can we improve the efficiency and effectiveness of the value chain overall? Then on the sustainability side, we want to understand which companies along this value chain apply best practice. For us, we call these A and B rated stocks. So these are the better ones in their respective industries. We want to integrate that knowledge in investment decisions. And finally, we want to apply stewardship to address the remaining weaknesses and issues we find in the portfolios. And let me go a little bit deeper into that, also with a few examples. So what are, for instance, new technologies in mining sites? Already now we see that increasing use of electric trucks is possible, electrified loaders is possible, emissions can be reduced with technical installations, energy is sometimes now generated from renewable resources in the vicinity of the sites, and very important is water treatment, water recycling. There's in many areas also water scarcity, so miners have started to do desalination to create the water and not draw the water from sources that then impact the local population, or even better if they recycle the water they have already used. But it doesn't stop there. This would just be the extraction. We can apply measures also in the further processing. For instance, when we produce the anodes or the batteries, there's also environmental impact, which can be reduced by appropriate measures. Even there, renewables can be used, and we can be more efficient also when it comes to the application on the end user side, like chip production or in the electric cars. So that's what we mean with improving the whole value chain, because if we are more efficient and more effective, there's less upstream pressure on additional extraction of strategic minerals. So you could call that also a more circular economy. The nice thing about these metals is they are not used up in most cases in the process. They are very stable. So you can use them again and again, reuse them, repurpose them, and recycle them. And there's quite some potential. Some of the metals which already now have a high price, gold, platinum, palladium, they're recycled at relatively decent rates, gold over 80%. But then already when it comes to copper and aluminum, recycling rates fall below 50%. And if it goes even lower to cobalt, lithium, or rare earth elements, that number falls even more. It's not easy, of course. That's also one reason why these numbers are low. It's not just the price. There's a couple of challenges. You have to collect these materials again from decentralized use. And then you also have to separate the materials from a battery, from a chip, and bring them back to the original use. Not easy, but there are interesting technologies in the market which address these challenges. Just a couple of company examples in no particular order. Upstream mining, for instance, Lundin Mining, one of the large miners involved in copper, gold, zinc as well, active around the globe, particularly Latin America, US, Portugal. They have good practices, but we will see a little bit later that even a company which does apply good practices has some weaknesses, which we may want to address through engagement. Arubis, a company from Germany, is one of the leading recyclers of metals, particularly copper, but not only. As a side product, then also they recycle nickel or zinc. The recycled metals market currently growing at about 8%. And finally, I mentioned the solution providers. Here an example would be the Finnish company Metso, providing leading equipment for whole systems, whole services for crushing, grinding, treatment plants, smelting, but also for the treatment of tailings, such as water recycling. If you now go further downstream, where are these materials applied? If you want to connect offshore wind power, you need a lot of cables. These are typically copper cables. Nexans, French company, would be an example doing that. Then the batteries, I'm sure you're familiar, themselves are obviously used in electrical cars like BYD and others. Or as simple as it sounds, we can address electric utilities. If we use more and more renewable energy sources, the power grids have to be upgraded in order to accommodate that use. I know there was a big discussion in Spain after the blackout, right? What that means, strengthening of the electric utilities and the power grids. This example here is now an example from Italy with the name of Terna. Now, best practice, what does it mean? Each industry, in our view, has their own challenges to overcome. And best practice means that we want to focus on companies which do a better job than their peers, even if they are in a difficult, highly exposed sector. At the bank J. we use something called the sustainability matrix to get some clarity around this. The way it works is that on the horizontal axis on the left-hand side, we have the industries which are highly exposed, obviously mining, but maybe also chemicals, oil and gas. And on the right-hand side, you will find the industries which are a bit less exposed, could be service-oriented industries, media, and so on. On the vertical axis, then, this allows us to show the firms respective in their industries. So on top would be the leaders, the best practice companies. At the bottom would be the laggards, which we believe incur additional risks because they are not there yet. What you also see from this matrix is that you want to apply a more critical, more selective approach in highly exposed industries. You can see that with the blue area on the left-hand side, we can be stricter with what we think are leaders, or the leaders we pick, or what is kind of neutral in the middle. When the industry is a bit less exposed on the right-hand side, it's a bit less critical. And I can illustrate that with two industries. Now, each dot here indicates one company in that industry, which we have analyzed. And you can see that in diversified metals and mining, highly exposed, we find very few companies which we believe are in the best-in-class universe. We find some in the neutral universe, which for us is still acceptable, but quite a few then in the red universe, where we would say too much risk, not yet there where they should be. We are more forgiving in the industry of electrical components and equipment. Again, the full distribution of firms in the industry, but a majority of them now being in an acceptable environment. The rest mainly in the neutral universe, and just a few firms where we believe they are not yet arrived where they want to be. I mentioned that even if you have leading companies, you may have issues. And I accept that. Some of our clients will say, well, you invested in this company and now they have this incident in their mine in Africa or in Australia or somewhere. So engagement for us plays an important role to have a dialogue with these companies to address these remaining weaknesses. We sometimes do that alone, but it turns out to be even more effective and efficient if we do that together with others. In this case, we often work together with PRI Advance. In case you're not familiar, this is a dedicated engagement platform of the Principles for Responsible Investments, PRI, focusing particularly on human rights in the mining industry and a few adjacent industries. So we were one of 120 selected investors on that platform, combining 30 trillion in assets totally in combination, which means when we reach out to these typically very large mining operations, we can speak with one voice. Not just does that give us a stronger voice, I believe it's also fair towards these mining companies that they can deal with one combined partner rather than having to talk to 120 individual investors separately on possibly the same issues. So how does that work? A few examples here. Lundin Mining, I mentioned, is actually a company relatively high up in our assessments, but they had some problems. They had a sinkhole in Chile, 36-meter wide, came as a surprise, had an impact on the local population. They also had problems with dust, which impacted the local population, and also had some fatalities. And we believe they could do better in terms of their risk management, of their early warning programs, and also how they deal with the local communities. And that was now a company where we find quite open doors to address these topics together. Another example is tech resources. There they had particular problems with indigenous people as well. The best standard there is so-called free, prior, and informed consent, also called FPIC. So we wanted that tech resources embraces this challenge, and in areas where they are exposed to indigenous people, give this local population a fair chance to speak up and approve the operations, not just on the government level, but also with the local communities. Two more examples. One is the German utility company E.ON. They faced some human rights issues and also some challenges on grievance mechanisms, which was not ideal. Yet that's another example where we engaged with them together on the platform. And finally, Alcoa, the aluminum producer from the US, they had some human rights policy. I listed this one, admitting that we have not yet been very successful in this particular case. You see it on the right-hand side. It took us through the platform 2 years to even get a decent, fair response of the relevant people at Alcoa to enter into this dialogue. So that indicates a little bit engagement can be a very lengthy process, because also the things that should maybe be changed at these companies, they are not changing overnight. So it takes a while to really start the dialogue, then be taken seriously, understand a particular business. We don't want to claim from the outside that we know a lot more about mining than they do. That would be quite arrogant. But we want to engage with them to show we believe you can do better. Now let's see together what that could be and how you could address that. So at least our strategy is to be not very confrontational in these engagement exercises. In our experience, we had more success in teaming up, not take them to the media, not expose them, but say, look, we actually want the same you want, which is a long-term successful company with as little damage as possible, because we want to invest, we want attractive returns with lower risk. So the objectives are actually aligned. Let's work together to create better outcomes. So in this combination, I believe it is a possibility to address minerals, strategic minerals, also as a sustainable investor. And if I may summarize this, and then we can open for a discussion. I think it's clear we are going to face stronger demand for these materials. We definitely need them for the energy transition. If for ethical reasons we say, no, I really don't want to touch them, that's fine, but we have to accept no energy transition without strategic materials. So I'm an engineer by training, environmental engineers. For me, I like pragmatic outcomes. So we have to make our hands dirty. If we need these strategic minerals for energy transition, we have to do, as sustainable investors, something about them. That doesn't mean we close our eyes when it comes to the risks. Yes, they are there. Severe environmental risks, severe social risks. We have to identify them. We have to create transparency, and then we have to try to address them. We believe we can address them through the three instruments we have. One is the full value chain approach, to be more efficient and find solution providers that give us some relief with some of these challenges. Number two, we want to focus on the firms which already today have the best practice. That means industry-specific analysis of the situation. That also changes over time, because these best practices, of course, they develop and evolve over time. And finally, we want to engage to address remaining environmental and social risks. I often then get also the question, can we also invest in commodities? Because, for instance, we have some clients which are pension funds which are not comfortable to invest in commodities. If they invest now, due to the new interest in the transition minerals in commodities, it's of course true. You cannot engage, you cannot address the weaknesses through a commodity investment. Because obviously you don't even know which company produced the material, or maybe you're even trading just futures, so you even have less exposure to the actual material. But what you can do is a combination of a commodity investment with an equity investment, which gives you access to the companies which are behind the commodities, and try to at least have a positive impact on the value chain, on these firms on the equity side, to give you some relief on the commodity side. That's a bit the range of solutions we can imagine. And I'm now very interested in hearing from your side if you believe that's an approach that has some validity also in the sustainability space, or if you have other perceptions or questions for me. Thank you so much so far for your attention.
Thank you, Daniel, for your comprehensive and very engaging presentation. It has been extremely interesting. I also want to congratulate you by the JSAFA's harassing track record. I has been impressed. And regarding the presentation, the main topic of the presentation, we can accept questions from the audience, but taking advantage of my position, I would like to ask you first one.
Sure.
You talk about the human rights challenges related to small scale mining, no? For example, in the Democratic Republic of Congo. What can investors or the public in general expect from large scale mining operators to address the topic if it is not part of their own activities? Do they have a proper responsibility, or is it just something that is not within their scope of work, let's say?
Yeah, look, that's certainly almost a hot question, right? Because purely legally, they don't have a responsibility. And that was maybe 10 years ago also a little bit their defense. They said, we're very sorry. We do the best we can with our own operation, but we cannot really say much about what happens around us. Now, this perception has not everywhere, but has changed a little bit. Because on the one hand, these larger companies run a reputational damage, also internationally, if they are in the news, because around them there are thousands of people dying. That's not good. They can even encounter some local problems that the local communities start protesting, blocking the permit process or blocking their gates if they think it's too dangerous. And at the end of the day, they also have to accept that these small scale miners, they feed at the end of the day in the exactly same value chain the big miners feed as well. At the end, these things are mixed in the market. So some of them have started interesting programs. For instance, to increase the safety in the local operations of the small miners by giving them equipment, for instance, or have an access control system. This is not super complicated. They could support them in having gates to see who is going to these tunnels, making sure no children are going to these tunnels. There's some programs where these large-scale miners work together with local NGOs, for instance, to ensure that children go to school. Because if children are in the mine, they don't go to school, and children are not super productive in the mine. So that doesn't cost so much to, for instance, compensate the family for the money they lose because the child is going to school, costs them a couple of dollars, and that's already then the same for the family and less risk for the children. So I think it is possible. It will be difficult to make it a legal obligation, but there's certainly a moral and reputational obligation, which by now has motivated them to do more.
And from your personal point of view, do you think that these large companies feel the pressure of investors also? You mentioned Alcoa, no? That it took 2 years for Alcoa to properly respond.
There is a lot. The response rate, as you say, they can vary a lot. Some of them are responding, some others not. I think the trick also here is not to just go there and blame them. These big organizations, they need also help to do what they can do there. This is not their core specialty to deal with the social issues of the small communities around them. So even if they want to, they may need a little bit of help. So what can we actually do? And I learned a lot personally about this because we have last year mandated a professor for human rights in such operations from Switzerland as our external advisor in our external advisory board, which helped us a lot shaping our engagement programs as well, because she, Dorothee Baumann-Pauli, she is an expert on programs that really work. And she engages with these large companies, trying to bring them to the point that they want to do it as well. So I really see it as a collaboration, but it's clear we will not always find the same openness. It's also a cultural thing, right? I don't want to name particular countries, but there's definitely countries which are very active in the mining space, which may not apply the same scrutiny when it comes to human rights protection.
Thank you, Daniel. Of course, anyone who is connected, please feel free to maybe by the chat or just open your microphones and make your own questions, please.
Can I ask a question, please?
Yeah, absolutely.
Richard de Chazal speaking. Daniel, thank you very much for your presentation. Very interesting. Quick question. I guess maybe Alcoa aside, I imagine a lot of these companies are quite small. How do you sort of manage the issues of size, liquidity, and volatility?
You mean from an investment perspective now, not necessarily from an engagement perspective, if I understand correctly?
Entirely from investment perspective.
Yes, absolutely. It's a full range of companies to cover. Now, if you were running a very big multi-billion strategy, you may have the challenge that you don't really profit from the development of the smaller companies in such a strategy. We are, you could say, unfortunately not there yet. So in the strategy so far, it's still possible, not to the super small size companies, but I would say mid to large caps, definitely possible to include companies which are not just big miners, but more on the solution side in the sense of water technology and so on. But you are right, of course, if you think really innovation of almost venture capital company having a new tool, that would, at least for now, not be part of the strategy we can apply.
Thank you. And thank you, Richard, for the question. I have another one myself. As I say, I work in the public sector. And recently, in the last few years, we have been financing or participating in the financing of different nuclear plants, which are sovereign sponsored, let's say. What is your point of view on nuclear for the future? Do you think that new renewables will have enough capacity to produce the electricity needed just from renewables, or do you think that nuclear still have a place in the production mix?
Yeah, look, nuclear is certainly tempting. Also, it's low carbon. The prices for solar and wind were a bit higher more recently, which also makes nuclear more attractive. At the same time, there's also a few challenges. One is, again, the lead times are super long. We saw the last two larger plants, Finland, UK, I think it was over 20 years, much longer than they expected, and the cost tripled or so compared to the original estimate. So that was not so great after all. But I definitely think nuclear will have a place in the mix, just not as quickly as we believe. So if we say right now we are limited on the solar and wind side and we want nuclear, well, if the lead time is 20 years, it doesn't help us with the energy gap with a short-term or mid-term perspective. Another thing is also, and now coming back to the commodities, uranium mostly comes from Russia, at least today. So that's a dependency also don't necessarily want, which first can be solved, but probably has to be solved. I think there's a higher chance for these smaller modular nuclear reactors, but even those are not so easy to get the permit, to get them installed, to get them running, to get the acceptance of the population around them. So if you look at, for instance, the tech firms in the US, which are very much committed to zero carbon operations and are looking in alternative energies, they're thinking about running their own or contracting small modular nuclear power plants. Maybe it comes to that point. I would support that. But they have also realized that it's not so fast. So some of them have now started geothermal energy. I think Google is at the forefront because it's much faster. Within 1 to 2 years, they can produce energy. And others, Microsoft and Meta, are now following as well. So short answer, yes, I think it's part of the mix. I do believe the international energy agencies in their protection. Earlier in the slides, I think we had one chart which showed a little bit of projection in terms of energy mix. But yeah, at the end of the day, nuclear plays also a role because it's a good base load, a reliable base load provision, whereas wind and solar are more volatile.
Thank you, Daniel. Of course, if anyone else wants to open the microphone and make a question, please feel free. From my point of view, and also thinking in terms of the final investor, I think I wasn't aware of the importance of the geopolitical situation in this market and the volatility that we are suffering right now. No? And also sustainable investing is experiencing some headwinds, especially from the USA. No? Maybe, do you think that this could be the end of a bubble, or what do you expect for the future, let's say?
Yeah, look, it's maybe a healthy correction we see right now. It's a bit painful also for people like me, because I'm very much committed to sustainable finance, right? But what happened, I would say, before COVID or before 22 was a bit overexcitement, right? It was also not very differentiated. Everything was suddenly sustainable, and everybody claims to have been sustainable forever. And you only had to put a label on something and it was good. That was a bit too much. It's natural that this can happen. We see it also with new technologies, but there's often a phase of consolidation, becoming more pragmatic, realizing what it really is and what it is not, and accepting the world is not black and white. There is a lot of in between, and we have to find ways how to move in a more sustainable direction. So from this perspective, and if we also see what's really going on in the background, I'm quite optimistic. There's a lot of political narrative and against wokeness and things like this, but we should look behind these dialogues. I gave you the example earlier about what's really happening with renewable energy, right? It's growing extremely quickly and for good reasons, and that's great. But we also have to be honest as investors financially. What already works in terms of returns and what is quite risky, or what works in which market environments. I think then if we are pragmatic and if we are honest to ourselves, we will be able to offer solutions across the board. You can call them all shades of green, I don't know what, which may fulfill the expectations and preferences of different investor groups. And then I don't worry so much about which label is given to which strategies, but it's our job as wealth manager to take all the information into account to create interesting investment opportunities. And the chart from the World Economic Forum, I think, supports that view. These are the challenges on the table. We don't have a crystal ball. We don't know yet how we are going to solve all these problems. But it's our job as financial analysts and portfolio managers to at least try to think ahead. What's a good way of dealing with these challenges in the interest of our clients?
Okay, thank you, Daniel, for that answer. I don't know if there is any other question from the audience, or maybe.
Hello, I'd like to make some questions,
Yeah,
if you don't mind. Hello, Daniel. Thank you so much for the presentation. Very interesting. So I'd like to address the topic of AI, very, very popular nowadays. So let's say that big tech companies are racing to get the best AI, so they're building these data centers, and from my perspective, they're not very eco-friendly, not very sustainable. They take a lot of water, they consume a lot of electricity, they damage environment, they raise the electric bill of from people of towns around. And also companies are fighting people saying that AI raised productivity, but some MIT studies say that many of these AI rollouts fail because they haven't been well thought before firing these people. So I'd like to know your opinion from ESG perspective, because I think there is some double standard with the AI topic. Thank you.
Yeah. Not an easy question indeed. And as you nicely described, AI comes with many also different challenges. But let me maybe start with the environmental one. Yes, needs a lot of calculation power, data centers, huge energy need. That's also one reason why some of these companies at least claim or promise to do that carbon-free or net zero at one point in time. Certainly additional pressure on the materials and metals we just discussed today. Even more important, it is to be efficient, to find a way to produce these materials in a more sustainable way, and hopefully in a low carbon way to operate. Because in my opinion, they are not going away, right? It's an illusion to think that these AI developments will somehow stop. Even Elon Musk had to realize that. You maybe remember in 2023 or so, together with a few other leaders in the space, he actually wrote an open letter where he asked for a 6-month pause in the development of AI, because even he realized this thing is a bit dangerous and what can happen to it. Let's first put some safeguards in place, some rules. But then he realized, oh, the others are doing it anyway. China is doing it anyway. So, well, if we're doing it anyway, I want to be part of the game. So that went quite quickly away, that letter, but it shows that even the experts, so the leaders there, they see the alarm signals, which you also have mentioned. Now, on the social side, yes, it's changing the world we live in, but truly, I believe it comes with many risks. Maybe not even so much in some jobs that will be lost, and some jobs, of course, will be lost, but we had other effects like computers or the web, which also changed the work environment for many people. And hopefully the social networks of the governments, like retraining people and so on, help people who are exposed to these problems to find new jobs. I'm a bit less worried there personally, but that's my opinion. I think there is solution for that. The job landscape and the talent we need will just change over time. But there is a lot of unintentional outcomes, I think, of AI application as well, particularly when we reach the stage where not humans control AI. Right now, it's still humans trying to apply AI for something, for a new program, for a tool, for a development. But what everybody's working on is AI using AI. Well, because that will be then a speed of millions faster. So if AI thinks by itself, to put it in naive words, we can now go after people to extract some money. It can do that. It can probably find ways to crack your passwords and have access to your banks. And even I think they did some experiments where AI itself started to blackmail employees in a company because they learned from email traffic that these employees wanted to slow down the application of AI in the firm. So AI of that firm didn't like it and said, hey, we don't want to be slowed down. And they started looking into private emails of certain employees, and they found some compromising information and started blackmailing these employees and say, please do not talk against AI in the next meeting, because otherwise we may make that public. So these things can get a bit out of hand. And I'm not so sure how we're controlling that the more we hand over. You probably saw last week was an interesting article that now AI is starting to employ people. So AI can, certain things it cannot do, right? For instance, close a door of an automatic car, then the car cannot drive anymore. Somebody has to go there and close the door. So AI can give out jobs or bring flowers to somebody in the 23rd floor and so on. And there's already 340,000 people, it seems, globally, which have voluntarily signed up to become an order recipient of AI. So for those of you who remember the Terminator movies, where the robots are taking over in a brutal way, I see certain risks that we are voluntarily handing over to the robots, and I don't even know where that goes. So sorry, that was a bit a long answer, but I think environmentally we can control, we have to solve it, but we have technologies. Socially, we need government action, we need social networks, retraining comes with some pain, but we had other huge changes in societies. But the actual meaning of AI what it can do, that is for me the big question mark.
Thank you very much, Daniel. We are running out of time, but I don't know if anybody else wants to make a last question. If not, maybe we can leave it here. Anybody? So I think that's all. Thank you very much, Daniel, for the presentation again. It was a pleasure. And we can leave it here. Hopefully we can rejoin soon.
Absolutely. Bye-bye. Thanks a lot, Alfonso. Thanks everybody for joining. Have a good evening.
Have a good evening. Bye.